What's up, everybody? Michael here. You're watching the Stock Market Brief Show. What do the bulls need to do specifically? What level do they need to claim to get a little bit more confident? We've had now not one, but 2 down days in a row. Ooh, that's rare here in 2023. Everything was down on the day as far as the index products go. Okay, we had, as far as the 11 sectors go, we had some there in the green. We're going to get today more into like where's money rotating, and then also get into specifics on the SPY. Today's video will be a little bit more compressed, so we're hopping right into it today. If we take a look at year to date as far as the S&P 500 sectors go, there's 11 sectors that make up the S&P 500. Towards the bottom of the list year to date, pay attention here. We have healthcare, utilities, consumer staples. These are all the worst performing, okay? Consumer staples, down 3.34%, down 2.3%, utilities and healthcare down 1.92%. Now, we haven't seen much price action year to date. Obviously, it's only January 19th, but what we have seen has been, quite interesting, right? A lot of profitless text, a lot of short squeezes, a lot of talk about zero-date option, gamma squeezes taking place. Well, what do we see going on here? Well, as far as the top goes, communication services, then consumer discretionary, and then real estate. So a little bit of a mixed board, but the decisive look here looks like as it starts into this year, defensive is being put on the back burner. And, I could show you a couple different relative strength type charts here. You can see gold, this is the safety trade, right? So this is all, so you know what I'm talking about. These right here are relative strength graphs. So basically it's gold relative to the SPY. So when the line goes up, that means that gold is outperforming the SPY. This is utilities. When it goes down, right, it means that SPY is outperforming utilities. When it goes down, utilities is underperforming the SPY. When it goes up, utilities is outperforming the SPY, and so forth down the list. So we're going to go through this. Gold is still a strong one. So that's interesting to watch because a lot of people might perceive this as a safety trade. It could be just a product of obviously, falling rates, real, nominal, etc. Utilities has been coming off a little bit here too as well, but it still has a higher high, and now we're right back here under that 50-period moving average. Consumer staples have also crossed below that 50-period EMA, but still, relatively within an overall uptrend there. TLT is relatively neutral. Defensive, this is going to be an interesting one to watch. This one just crossed down through the 50-period EMA, but you can see it has been in an uptrend there too as well. So really, it's taking a breather as it stands right now. No really strong technical damage from the perspective of relative strength. And then you have healthcare right here is kind of curling itself back up, potentially going back up through, which could create, just another series of higher lows. So that's interesting to me. Another way to look at this is through a relative rotation graph. And I can see here the defensive names such as utilities up in that improving quadrant, leading over here consumer staples. You have industrials in the leading quadrant, which we're going to talk on, and then we have XLV there is heading towards the weakening quadrant. And this is looking at a 5-week basis, okay? And if you just take a look down here, right, you can see the SPY is in the middle, and then you have XLV, XLU, XLP as the worst performers in the last 5 weeks there too as well. So defensive has been kind of put to the back burner, and we see a lot of risk-on type behavior. That is how it stands currently in this market. Now, that can obviously change. What I'm showing here is the zones. Now, I want to remind everybody that I'm going to go ahead and turn this red. All this stuff, this was all pretty much red not too long ago, okay, as far as where it stood, where price was within the zone. Meaning that, hey, if we have, the upper range up here, lower range down here, if it's red, that means price is floating somewhere around in this area, okay? If it's green, it's floating around somewhere in this area. They're dynamic, they always change. But this has been really red, and that's what gave us insight to saying, hey, take your foot off the gas a little bit here. Yeah, we're getting a squeeze in various products, but as you can see these last couple of days, it got hit, and now everything's changing. Now, I want to call out a couple of things here that I've seen. So XLI, this just now got into the green. Industrials have been getting hit pretty hard. We talked about XLV being down here. Dow Jones Industrials, or the diamonds, DIA is down there now because they've been getting hit hard. XLP and XLU still remain down there too as well. So as it stands right now, we know that from a defensive standpoint, right, they're not performing that great overall for the year to date. and the relative strength is coming off slightly, but it's still an overall uptrend. The zones are telling us, hey, they're reaching potentially extended areas. In my opinion, nothing really from a macro standpoint has changed. So yes, we're seeing these rotation and risk on assets, but this still tends to me to be an area of opportunity for the next trade looking forward, where we can see a potential move in these, at least. That's kind of how I'm perceiving it. So this doesn't mean go all in utilities, go all in consumer staples, go all in industrials. That's not what this means, or go in healthcare or whatever. But it does mean, hey, if you are looking to still be positioned somewhat defensively, you can incrementally add into things like this while they're at the lower range of those zones. Now, more specifically in industrials, I want to hop into that. If I look year to date in the industrial sector, this is the industries that are within it. So you can see airline's been doing fine, transportation service. So there's been doing some good. The one that is interesting to me is defense, right? So defense is what? It's more of a safety trade. I pointed it out over here. So DEF relative to SPY just crossed underneath that area. And when I go into a little bit deeper detail of the defense sector, right? This is down 10% year to date. Take a look here. These are different individual equities that fall within that industry. But towards the bottom of the list, you're looking at all large cap names that got hit. Yeah, some of the small caps, right? These all ran, which we've seen, a lot of small cap names, not just in defense, but everywhere across the board, have been doing quite well. So it looks like, yeah, at the beginning of the year, small caps are doing fine. It's the defensive sectors that are large cap have been getting hit. Which could open up a potential opportunity. But yeah, so like NOC, right? It's down 18% on the year. LDOS, Lockheed, right? LMT, LHX, General Dynamics, and so forth down the list, okay? Now, if I just pull up like aerospace and defense, right? This is another sector that you can potentially watch out for. ITA, you can see some pretty strong distribution. This is just an ETF, it's if that carry some names. Pretty large distribution days as far as potential for institutional type selling. However, it's still within an overall, just sideways consolidation. So it's going to be something to continue to watch. These were pretty significant moves, so potentially, a little bit more downside, but I can see the possibility for a potential bounce here in the near future. If we look at year to date for the utilities sector, take a look here. Yeah, they've been getting beat down, but hey, pay attention to gas distribution. They're actually up year to date. So if we do start catching a bid, potentially gas distribution might be a potential area to watch. As far as consumer staples go, we have food retailers and wholesales. They're actually positive year to date, but you can see soft drinks is actually in the lagging quadrant, which we've been seeing things like some great charts like Monster, Celsius. Those were good names that were holding up relatively well, but they've gotten hit more recently, showing quite a bit of distribution. So it's going to be continue to watch that. You can go into individual names, or you can just scale softly into ETFs if you don't like the volatility of single base names. But that is kind of what I'm seeing right now currently in the markets. This is what I'm paying attention to as far as potential opportunity for the next setup as the market kind of came off a little bit. And keep in mind, we have earnings coming up. A lot of these names might have earnings too as well. So just be on guard for that. I want to hop into the book map levels. This chart was actually from yesterday. And I just want to point out once again, like how important it is to understand where like orders are hiding out. You can see here we had to the upper side 39.87. To the lower end, we called out this. It was just above 3,900, probably 39.09, 39.10, whatever. But take a look here how the day proceeded, right? So these are the yellow lines from yesterday, and you can see, right, the market opened up, came down. It really, the day didn't do much. This is actually today's trading day. You could see here where did it tag? It tagged right there into that yellow line, and that's kind of where we started finding some movement back up to the upside. So overall, a pretty stagnant type day. Going into tomorrow, I mapped it out again, some levels that have some significant areas of liquidity that you might want to pay attention to. 39.60 is above us, and then 38.60 is below us. That's for ES. Now, what do the bulls need to do in order to kind of regain some confidence? Well, for the first day, in a while, it was really since the very beginning of the trading year, we now have closed beneath the year-to-date anchored VWAP. So this is, right, so after this gigantic rally, right? It took 2 days, and now we're below, boom, 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 the year-to-date anchored VWAP, which means what? Based off of time and volume, the average buyer, based off of volume, is now underwater year-to-date. Okay, so if you are doing good year-to-date, okay, congratulations, but the average buyer of the SPY is now underwater. And sometimes this can act like a pendulum, right? So if all of a sudden the average person is underwater and it continues to press down lower, it could very well proceed with more selling or stop losses getting hit, because as the average grows more into negative territory, people tend to, capitulate or get out of their positions. Okay, so what do we need to see as far as more confident for the bulls? Well, the high of today's candle, it would be nice to see a close above that area, because first and foremost, that would give us back above the year-to-date anchored VWAP, and it would show a good sign showing that we've closed above the prior high of the day, showing some strength back from the bulls. Now, overall, you can see I drew out a little channel here for the SPY, and you can see it's been tagged multiple times on the high end, multiple times from the low end, and even in the middle of the range, there's actually been quite a lot of price action within there, and recently holding up as an area of resistance. Yesterday, we talked about the evening star reversal type pattern. Well, we got follow through today, but keep in mind, we are still beneath that week to date expected move. So price tried to get back up there. I wouldn't be shocked to see price try to swing up there again. This is its safety zone, okay? Be aware, there's a couple things that we want to pay attention to. Dynamic hedging is real, right? It could kick in and we can get continued selling. We've seen what it looks like from a zero-date options to the upside, but we haven't really experienced it, right, from the downside this year, unless if, that was part of it. A couple of things also to note here is, as price was moving up, right, as we were getting the series of higher lows, higher highs, what was happening with our indicators? So the price momentum oscillator on this time frame, the RSI, they were both diverging from price. So this gave us insight, as well as the zones being lit up red, that, hey, this is where you got to be careful, right? The bulls are in control because they're above the 5-day moving average. Now, the 5-day moving average is curling over and price is underneath it, well underneath it. You can see down here. So it's more bearish as it stands. So even if price were to come back up here, right, be aware and be careful, because as this starts to turn over, we could simply do something like that and start cracking lower, okay? That's not a prediction. It's just a potential possibility. So it's always important to understand the short-term trend. The long-term trend is important too. The long-term trend, we have wind at our face, right? But the short-term trend, or we can call this the trade, it requires a lot of positive bullish trades in order to change the overall larger trend. Okay, so what could potentially happen tomorrow? Well, I would watch out for this. This RSI got very extended to the downside. We started bouncing. So if we can crack the low of this, boom, I don't think that the RSI is going to go deeper than that. So if it starts getting underneath that and starts curling back up through 30, making a U-turn there, that could be a potential positive divergence. And then we could potentially play a short-term pop to the upside, or at least be aware that, hey, momentum to the downside could be slowing at this time. And that's, right around this prior area of prior support. And that prior support was also where? It was right here back testing the chop box. So we came up, we came down. So if it comes down like that with a positive divergence where we saw prior support, that could present itself as an opportunity to potentially go long for like a very short-term trade, or cover some shorts, or just be aware of that. From a shorter term perspective. If we don't get that, I would just be watching that 392, right? Price 68% of the time, right? Tomorrow is our last trading day for the week. 68% of the time, the S&P 500 finishes within the expected move. So that means price would come back within here. So that's also a very strong possibility. That's all I got for you on today's show, everybody. Hope it helped. See you later.